talked about the key issue always, I think, for people, and that is risk. How do you go about, when a customer comes to you, how do you go about establishing parameters? Obviously, age, how much money they have, how much money they're making, all these things come into play. But risk is the most important thing, because you've got to preserve, I think, first and foremost, as a, as the keeper, the gatekeeper of your client's money. That's your job first and foremost. So how do you go about doing it?
Well, I say that risk is a four-letter word. Let's say that first of all, okay? It's definitely something that is the dirty language, because there's ways actually that we think that we can contain risk. Containing risk does not always mean that you're going to be successful at it, but risk mitigation is a big part of what we do. So we use things like, we may use options, for example. We haven't been really excited about the options this year with the VIX as wacky as it's been, although lately it's a little bit better. In the 20s, it's still very high, and option pricing based on volatility is really much higher than we want it to be. To utilize like a long-term put, let's say, against a portfolio, we find it to be a little bit expensive to do that right now.
Do you tend to buy options then?
Yeah, we'll buy options, but, we use covered calls for a long time. But I got to tell you something. After last year, before last year started to really get ugly, we pulled out of our covered call strategy because we said, you know what, we want liquidity. Yeah. And that's a big issue when it comes to the risk. And you know what, if we have covered calls, all of a sudden I start selling the underlying security, we got the naked call sitting there. That's not a game we want to play. Right. We can get really busted up. Now, obviously, it would have worked out fine because we would have made
it works in up
very limited strategy. Yep. So, either a flat or a little bit of up trading. But when the VIX is where it's at this point also, what we're finding is that we can't get, for a while, we haven't been able to get good premiums on a lot of positions, but yet the put premiums have been out of control.
Right.
So, we could sell puts to try to enter into a position. We can do that, as an uncovered, just a put, sold. And we could do that to possibly enter into position, and hopefully if it moves down, we get that, and we're saying, okay, well, if we get the position at that price, we're happy. But risk also, we try to do a lot of advanced economic work. Now, between economics, technicals, fundamentals, and quant, we use what's called a quanta funda techna. So quantitative analysis using screens, fundamentals, looking under the hood, looking at the various ratios and understanding balance sheet and cash flow statements. And then the technicals, understanding, when's the good buy point, what is the support, and, a variety of other indicators. The problem has been that a lot of stuff has been turned on its side lately. I mean, we can't even get a reasonable level of down move before all of a sudden there's money just being flushed in the market. That's a good thing. The liquidity trade is on. The risk trade is on. But the truth of the matter is that there's something a little bit lopsided with all the basic indicators when we're seeing earnings coming as they are and all that. So what we told the clients about today versus what we would have 10 years ago, because 10 years ago was a big discussion about asset allocation. We talked about diversification. We talked about all these different things. Diversification meant nothing in 2008. You could have been in the most diversified portfolio in the world, just incredibly diversified, true diversification, based on like mean variance optimization, all these great studies that were done by Brinson, Briebauer, and Hood in the years past. The fact of the matter is it didn't mean anything, okay?
Well, I would actually argue with you that it's the same today. I think correlations are
No, I agree.
I think correlations are, so not argue, but I would say that, today we have the same problem. Everything is moving together to the upside, just as everything moved together to the downside. So you're absolutely right. I mean, all asset classes are rising, whether it's stocks, commodities, futures, currencies, everything, except for the dollar. Everything, and so that's the trade right now. The dollar goes down and everything else inflates. And as you said, that is the risk trade right now. So
and what's interesting, don't you find it interesting that the dollar really never had this kind of, there was no relationship like this ever before?
Never.
There was clearly if you overdid it on either direction, right, And let's also say to everybody listening, we never had currency swings like this before. 1% currency swing, you'd go and hide in a closet for a 1% currency swing. And now it's like, oh, the dollar's up 1% against this one. I'm like, what?
Right.
It's a whole different environment right now.
And I think, Andrew, part of that is, again, because it is what I call intervention nation we have become. We don't let things flush out. Nothing does. Everything is either too big, too small, or too medium to fail. We don't allow these things to flush themselves out with the natural market occurrences. So we're almost moving towards a socialistic approach to our monetary and fiscal policy, because jobs are related to whether it's car companies, whether it's insurance companies. So votes are attached to that, and we get into the spot where again, nothing is happening. You've got a lot of zombies out there. You've got a lot of assets that aren't worth what they're saying. You can't short them because it's too dangerous because of this intervention that goes on. So you're kind of in this stalemate, and it is a really weird time. And that's one of my big problems right now is how do you define that risk? And so I'm curious, from a money management perspective, it's a lofty, difficult bag to carry right now.
It is. And I'll tell you something, just to go back on your zombie discussion, it may be for you as a trader, you could trade a Fannie, Freddie, or an AIG, but we look at it as like one question. Why are those stocks still trading? Right. I don't even understand. It doesn't make any, who is allowing these stocks that are basically dead in the water to keep on trading, and for what purpose?
Well, it's simple. It's all the jobs that are associated with those companies or, the federal entities. That's all it is. I mean, General Motors, why was it trading for as long as it did? It finally went bankrupt, and now they're back in business with $80 billion. That's not going to, it's not going to save it. It's just going to.
But all I'm saying is they should have taken that off the market. There's no reason that they should be trading. You and
I could probably sit down here and pick 500 names that are like that. I could probably give you 500 banks that are like that tomorrow. Right.
So, exactly. So as a money manager, it's risk. So what do we do? One of the things we have to do is we have to watch our first of all, position sizing. It's really important with our active portfolios. Okay. Let me just back up and say something. We have different kinds of portfolios that we manage. And let's just break it up into two different components. One we'll say is our aggressive active strategy. We call that the disciplined investor managed growth strategy. We say it's like a hedge fund without being a hedge fund. Everybody has their own individual accounts, okay, $50,000 minimum, whereas traditionally on the other side is a $500,000 minimum. And in those accounts, we can trade rapid fire if we want. We can buy and hold. We can short. We can go long. We can use options. We do what we want in that account, okay? On the other side, we use our global allocations, primarily ETF organized and diversified. Okay. And what we do over there is we'll have Brazil, and we like the BRICS minus the R. Right. So we got Brazil, India, and China as an example. We'll use anybody that closes their market on any given day because things aren't going well. Yeah. We don't like them so much. I mean, I can't deal with that. Okay. And then on top of that, and it's also too related to oil. I mean, it's like directly related to oil and correlated there. So we'd rather have an oil play if we're going to do that, or some kind of other, energy play. And then we'll have some gold. We have silver in there. We have some material ETFs, et cetera. We'll go short if it's appropriate to go there. We'll have more cash. We have some core bonds in there as well. Okay, that's that side. Not as much trading over there, but we're not going to sit on that forever either. And we'll use sector allocations and more tactical allocation. On the other side, we're active, very active on a daily basis. We'll add to a position. So we start out, for example, risk management, with a 1% position. May not seem like a lot, but that's what we call an initial position. And depending on our level of desire on how much we either like it or a commitment to that company or a conviction, we'll add to it. We'll double it. We'll go to 2. We'll go to 4. 5 is the max. So right now, 5, for example, is a Microsoft, is a Walmart, for example. 3% is Consol Energy. 2.5% has been Sears for a while. Now, the problem is with these markets, you can get taken out very quickly on any of these. We have stops that we use. You have to be careful, though, because right now the game is all about the 50-day and the 20-day moving average. Right. And it's all about key support areas. It's uncanny how a stock will drop on an overnight earnings report or during the day right to that key support level, right, and then try to make it above its 50-day again. Right. Or you take a 10-week moving average, a simple 10-week, and find where it's going to kind of come back to a 10-week and kind of ride it for a little while. And it seems that if it does that for long enough, especially with an inclining 10-week moving average, it starts to pop off. Right. It's this game that's being played. What it is a professional hedge fund money manager game that they've used and almost to a point bastardized. They've gotten to a point that is ridiculous. Yeah. So what we're doing right now is you have to look at fundamentals, okay? But when you look at fundamentals, you have to understand one thing that's very important. It's like an amateur hour out there. Yeah. Last night, Fuji, a Chinese jewelry company that's been just on fire. Very little thin trading sometimes, but lately it's been much better. It was up over 10% in the after hours due to their earnings report, and it dropped close to 20% right afterwards. Now, what's happening? It's all headline based. Yeah. It's all amateur headline based that you're just buying in because it came out and then they drop it right down.